Welcome to Stock Watch with me, Ntaoleng Lechela. And joining me to unpack your stock-related questions today are Jean Pierre Verster from Protea Capital Management and Alex Duys from Umthombo Wealth. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392 or on X @BusinessDayTV using the hashtag StockWatch. Gents, thanks so much for your time this evening. And shoo, what can we say? It's really been a bloodbath in markets. My fave, Simon Brown, would call it a sea of red. How are you making sense of it all? This, of course, on the back of, the conflict playing out over in the Middle East between the US and Iran, and of course, concerns around high energy prices, Alex.
Good evening. Certainly that. If the war continues, the risk is, of course, that oil prices will remain high, which will lead to high inflation and, perhaps a reverse of interest rate paths. So that's causing a little bit of panic, and as a result, we're seeing quite a material sell-off. The sell-off today on African market is pretty much the 9th largest we had since the global financial crisis, to give you some perspective. So it's quite a material one, on par with the sell-off we saw in GFC as well as in COVID period. So certainly at the moment there is a lot of fear, but I think for professional fund managers it gives a lot of opportunities. So certainly going to be very good buying opportunities. So rather be on the lookout for where you can perhaps pick up some quality stocks and where you see relative opportunities and so forth. But certainly in the meantime, the situation could change at any time, so we have to follow the facts. Be adaptable as situation changes, but at the moment I would say that it's more likely not that perhaps there was a bit oversold in the moment, but my opinion could change as the facts change.
JP, Alex painting, a downbeat picture there. It does seem like, this war will escalate. We've heard from President Donald Trump saying it could go on for weeks. Are you pricing in any economic shocks? We highlighted there that if prices remain at the levels they are, oil prices, that is, it could of course translate into higher fuel costs, as well as, that trickling down into inflation.
Yes, indeed. And that's why we have repriced today. 9th biggest drop since the GWC, as Alex has said, which takes us back to levels of last week. So quite interesting.
Putting things into perspective.
Or at least a few weeks ago. I'm being a little bit facetious. But the point is that we've had an amazing run. The market was up 7% for the month of February. So it really has been an amazing run. Yes, there is this concern about higher energy prices, what that means for inflation, and also a difference in the market's perspective, literally from yesterday to today. From thinking, oh my goodness, this is just going to be a few days, to it's going to be whatever it takes. And this means it could be weeks or months. And that Iran is being quite clever in how they are responding by just dropping out missiles and drones all around them to countries that have US bases. So it's a fluid situation. As Alex has said, you must change your opinion as the facts change, as new facts come in. But we must remember, if we zoom out, that we are still at quite expensive levels in general on the local exchange. I would say specifically in the precious metal miners. I've been going on about them. And normally in an environment like this, with war, you would think that the precious metal miners and gold price would go up. But they haven't. They've also dropped. And that's because they are a hedge, but a hedge can't be expensive. If a hedge is expensive, it is not a good hedge. And I think a lot of people also realizing that at this price, the gold price and the gold miners are maybe not a great hedge. And that's why literally just about all shares on the JSE ended sharply lower today.
All right, so where are people hiding their money? Or because we can see that they are taking some profits when it comes to gold and the miners as well. What I found interesting is how the dollar is, seems to be back and clawing back that safe haven asset appeal again, JP.
Correct. So short answer, it's dollar cash. It's not Bitcoin. It's not precious metals. It's not treasuries, because yields have actually increased a bit because of the inflation concern. So people are running to dollar cash. That seems to be the safe asset for this round of nervousness.
So dollar seems to be king at the moment. What I've also found quite interesting is what's playing out in the energy markets, Alex. We've also seen coal ticking higher today. Is this a story around, I guess, limited LNG and oil supply on the back of the war?
Yes, correct. So thermal coal prices has been up, doing very well of late. So obviously with the higher oil prices as well as gas prices, that feeds into higher coal prices at the moment. So you saw, for example, Thungela up over 19%. And that's not because Thungela is doing particularly well at the moment, just because they are obviously very geared to a higher thermal coal prices at the moment. So yeah, let's see how it pans out. We remember in the Russian-Ukraine war, when started out, thermal coal prices have been very, very high. I'm not saying we can see a repeat of that, but to some extent, there is a rally there, and if it's sustainable, then something like the Thungela looks cheap. But as I said earlier, I mean, I would be cautious to pencil in, too much of what's happening at the moment and to perpetuate it. I mean, the situation changes quite frequently at the moment, but I think today's movement is a combination of the big move in thermal cost prices as well as Thungela being quite under-owned at the moment. I think a lot of fund managers have sold it over the last few years.
Yeah, I mean, are you seeing value there then, JP, with the kind of uptick we are seeing now? Perhaps a Thungela, perhaps an Exxaro?
Not yet, no.
Okay.
I would be careful by changing my portfolio substantially just as a knee-jerk reaction to current news events. Yes, some of these events could be seismic shifts that impacts the longer term, but there is also a scenario where a lot of these things reverse. So, if you go back and you see what happened with Liberation Day, 1st of April last year, you could have really made some very dumb decisions by changing your portfolio a lot just because of the big movements we saw in the first few days of April last year. Similarly today, I would just caution to say, be careful to rush into things that might show a spike now, or get out of things that might show a bit of a drop now, if you think that the long-term fundamentals of those companies are still sound. Or in the case of Thungela, maybe not so sound. It doesn't mean that all of a sudden you should rush into Thungela. I mean, the trading statement today said they're going to make a loss. There's impairments. Yes, you've seen a little bit of an uptick in the world coal price, but it needs a lot more before I would see value in Thungela.
So prices might be elevated, but operations and how they're doing in terms of operational efficiencies still matter. Alex, let's take a look at some of the day's company results. It's been a really busy day. Kicking things off with Discovery. Earnings continue to grow on that front. We're even seeing improved new business value, with the group really attributing its strong showing to its shared value model. Your thoughts around those numbers? Yes, earnings up double digits, but we did see that share price moving sideways on the back of the risk-off sentiment.
Yeah, I mean, I think I won't read too much into share price movements today, but on Discovery, on face value, I guess if we look at the headlines, it looks like a strong number, but we've always been historically cautious about Discovery. We prefer companies that, I guess, has got more, how can I say it, simple type of accounting, easy to understand, backed by cash, high quality of earnings. So our preference is for other firms in the sector, like a Sanlam, for example.
Okay.
I think kind of positive on Discovery. I think the fact that the bank has gone profitable from an earnings perspective, I'm not sure from a cash perspective, and I think Ping An has probably done a little bit better than I've given credit for over the last few years. But so I think there are some positives in the set of results, but in overall, I think the valuation looks for me quite full at the moment, to be quite frank.
Are you applying the same caution when it comes to Discovery, JP? Alex highlighting there that we are seeing a strong showing coming out from Discovery Bank. I think they said they're adding 1,500 customers a day.
Yeah, so I'm cautious about Discovery relative to the current share price. The share price has done extremely well over the last 18 months or so. So for me, it is relatively fully valued. But when I look at the accounts, they actually cleaned up the accounts a lot when they implemented IFRS 17, also about 18 months ago. So in the past, there were some concerns regarding the assumptions that they made. IFRS 17 makes accounting between life insurance companies more comparable. And some of the assumptions that Discovery has implemented in their accounts is still less conservative than the likes of Sanlam. But I would say the gap between the conservatism between the companies like Discovery versus Sanlam has narrowed a bit after the IFRS 17 implementation. So I'm more comfortable with the reported numbers of Discovery versus what I had been before. But the share price having done so well means I think that it is relatively fully priced, and therefore I also would prefer something like Sanlam or Clientele, a much smaller insurer at current prices. Yes, so on that basis, I mean, Clientele did amazingly well, and they're trading at a like 25% discount to embedded value. Also needed to clean up the accounts. They had some acquisitions. So that's an interesting one. Much smaller, but an interesting insurer listed on the market.
Maybe let's talk broader insurance players on the JSE, then JP. Take me through some of your thoughts around, I guess, something like an Outsurance, out with a trading update. I think it was last week. Strong showing on that front. We can even look at something like a Momentum and a Santam.
Yeah, so if you look at the short-term insurers, Outsurance and Santam, strong performance, but if you go back a year, the cycle was very hard, meaning they had pricing power to increase premiums. Now we're going to a softer cycle. You see some pressure specifically for Outsurance in Australia. So again, I think that the big move of last year in the share prices of Outsurance and Santam took them to full valuation levels. In the more life assurance space, Momentum still looks good. It traded at a new all-time high a few days ago. Conservative accounting, really doing well in the investment side of the business. Old Mutual, still a bit of a turnaround, still a wait and see approach I would take there. Sanlam, I think, is the one that's doing really well with a lot of the acquisitions, especially exposure to India doing well for them. Like I mentioned, Discovery for me looks a bit full.
Let's zoom in further into the financial services sector. Looking at banks, right? Nedbank kicking off the banking earnings season today. Really a period of a lot of strategic shifts, right? From the disposal of EcoBank to the acquisition of Kenya's NCBA as well as Ikoka. Jason Quinn calling it a transformative period. Alex, considering all these strategic shifts and the health of its balance sheet, do you think Nedbank is in a better position, considering how competitive that industry is as well?
Yeah, I'll probably say of the big four banks, position of big four banks, Nedbank's my least preferred, despite being the cheapest from a valuation perspective. I think this set of results was a low quality beat. If you look at it, it was prominently due to lower credit impairments. I mean, credit loss ratio was, I think it's 66 or 67 basis points, which is at the bottom end of the spectrum. Very weak top line growth.
Yeah.
And they're doing acquisitions, as you say. And, it's time will tell if these acquisitions will actually add value or not. The price actually paid for the asset in Kenya is actually earnings dilutive, concerning the premium they paid and the high cost of equity in Kenya. So they're struggling with growth. They really need to get scale in the retail space where they've been struggling for a number of years. But perhaps they can do a little bit better on the corporate and commercial side of the business as the economy starts picking up and you're starting to see more investment from the private sector. I think the valuation has re-rated a little bit, probably too close to fair value relative to its own fundamentals. But if you look at relative to this African bond market, bond yields, it's still quite cheap there. So if you want to play banks relative to bond markets, I think there's still opportunity to be made. But pretty much the same can be said for other banks as well. So Nedbank, it's okay, but I think there's probably better opportunities out there, to be honest.
What do you have to say about that then, JP? Are you sitting back and holding on to Nedbank, perhaps hoping that those acquisitions become earnings accretive, or are you perhaps holding back?
We are holding our Nedbank shares still. As Alex mentioned, it might have the lowest returns in the sector of the big five banks. Also the cheapest. And that's a tricky thing with banking shares because it's such a relatively stable industry. Valuation counts for a lot. And sometimes the bank that might operationally not be doing the best, but is the cheapest, does the best in terms of share price performance if you buy it at the right price. So we've been holding on to a significant banking exposure since middle of 2020. So we're now almost 6 years into having significant long banking exposure because we felt they just got ridiculously cheap after the COVID collapse that a lot of the banking shares went through.
Do you hold ABSA as well?
Sorry?
Do you hold ABSA as well?
We've already sold our ABSA.
Okay.
So that's one of them we have sold, but we are holding on to our Nedbank, our Standard Bank, and our First Rand. And as these shares keep on rising, we'll keep on trimming so that if they continue to do well, we'll probably end up with much less banks. But if you take us back 5-6 years ago, we had a lot of long banking exposure, and now we have reasonable banking exposure, including Nedbank.
Mm-hmm. And I'm sure it's not the same when looking at retailers, because they haven't had a really great time. But one retailer that continues to shoot the lights out is ShopRite, right? Even with that low inflation environment, we are still seeing the company moving volumes, and that, of course, helping it deliver growth in both its top and bottom line, JP. Let's just get your analysis on the results we got out today.
Very strong results, very difficult environment in food retail with some deflation at the end of the period. The presentation was very good. The management team explained the numbers. And again, there are clear winners and losers in the food retail sector, with the winners being ShopRite and Boxer, and the losers being Pick n Pay and Spar, and Woolies being somewhere in the middle, with the food business probably doing better than average, one could say. Mm-hmm. So it's always useful, specifically for a hedge fund, if there are clear winners versus losers in a sector, because that creates opportunities to go long certain shares and short others.
Mm. And, you know, your take around the retail sector then, Alex, just zooming in on those grocery players. We got those numbers out from ShopRite. We've seen those downbeat updates out from Pick n Pay, out from Spar as well.
I go with Jean Pierre there, so we also own ShopRite and Boxer.
Okay.
I think execution risk in Pick n Pay in Spar is extremely high. So in case of Spar, they've got obviously balance sheet risk as well. So that makes the situation worse. I mean, actually recently did a bit of a deep dive in Spar, and I was shocked to see how the lack of store growth in the business. I mean, Super Spars haven't grown in almost 10 years, and the normal Spar brand has actually gone down since 2015 or so. So really not really rolling out stores a bit, and been rolling out Tops and some pharmacy stores. So that shows you how much market share they've lost. Obviously, Pick n Pay the same thing. A lot of problems. At least Pick n Pay doesn't have balance sheet issue at the moment, but they are burning through cash. They still got optionality. They can still sell, of course, more boxes, perhaps even the clothing side. So they've got options, but enormous execution risk. And you don't want to be in those management shoes competing against a behemoth like ShopRite, where they are spending 8 billion a year. And they've got already the hearts and mind of the market and the clients, and they're doubling down. So I think it's going to be very difficult for those companies to turn around in the short to medium term, if at all.
Yeah, I keep asking myself if there really is light at the end of the tunnel, particularly for Spar, considering what we've heard over the past few weeks or so. I want us to stick within that grocer sector, but looking at some of the food producers, then Alex, perhaps maybe walk me through your analysis around what's been playing out at Libstar, right? I think it was sometime last year where we heard that the board is considering buyout bids, but pouring cold water on that overnight, and we did see the share price taking a hit.
Yeah, Libstar's been fortunate since it's came to the market, since listing. It's disappointed. Hasn't really produced a string of results that you could say is good, warrants a valuation premium and so forth. So return metrics are very poor. Share price has been poor. Capital allocation historically has been poor. Quality of assets has been great. And it's quite unclear on the strategy going forward. And I think when other potential suitors were looking at the assets, they were probably not too impressed. And I think it's probably best for Libstar to perhaps be sold by a piecemeal basis, because it doesn't seem like there's too much interest in buying the group at the moment. Or they need to continue, try to trade themselves out of the situation, see if they can do some bolt-on acquisitions. But it's very difficult when you've got very lowly rated scrip, and you don't have the strongest balance sheet and cash generation abilities. So I don't really see the investment thesis for Libstar at the moment, so not surprised to see the negative reaction after the deal was not announced.
And consolidation has been a big theme within that sector, JP. We saw what happened with Premier and RFG. But perhaps let's get your take around Libstar as a standalone company, as we are seeing that the board rejected those buyout bids.
Yes, I don't have much to add from what Alex has said. I agree that the business came together via private equity, which cobbled the group together from independent businesses. And maybe it's time that some of these businesses become independent again, and then there'll be different buyers for the different parts of the business.
Mm-hmm. What about RSL Foods? We saw results out of that company yesterday. The sugar unit, of course, continuing to hamper its overall performance. JP.
Yes, so sugar was the big drawdown in the results, as you correctly said. Grocery, also some headwinds. It's also an interesting business where they thought about separating the sugar business. They had separated the Rainbow Foods business.
Yeah.
So again, there are some groups on the JSE which have different divisions within them, which might not make complete sense to actually be together in one group. And it might make sense to break some of these businesses up. And you can foresee that if you put some bits of Libstar together with some bits of RCL, and you spin out more commodity type businesses like sugar, you can get a different business, a different group that looks more attractive from an investment perspective. And that's partly also why the RFG Premier transaction is interesting, because there are parts of RFG, like the export of fruit pulp, which don't necessarily fit a group, I would say. So there might be some further deals after they've taken over RFG to maybe sell some of the divisions that they bought when they bought the whole group. So I think there's a lot of work for M&A advisors to do in the food producer space because of these divergent divisions within some of these listed groups.
All right, so we're probably going to see a lot more, M&A activity within that space moving forward. All right, gents, let's get your stock picks. Alex, where do you see value at the moment? Are you buying the dip? Are you holding on to cash?
No, certainly looking to buy. So we've been quite favorable about SA Inc. at the moment. We think there's a lot of opportunity, specifically in the mid-cap space. So we like Italtal at the moment. I think it's pretty much trading at levels at COVID or about 12 years ago as well. Very strong cash generation, very strong management. The business is going through a difficult time at the moment, but we are backing them that they can trade themselves out of that situation. And if SA economic activity picks up to 1.5% to 2%, we think they will start growing the top line again, and then the business will be very well positioned. I think also in the meantime, it's very highly likely that Italtal will either do share buybacks or special dividends at the end results.
Okay.
So in the meantime, we're going to be paid handsomely double digits returns, we think, and option on perhaps a recovery over time. So we think it's one of the better opportunities at the moment in the retail space.
And JP, what are you hanging your hat on this evening?
I'm picking an offshore share. It's a company I picked, I think, about a year and a bit ago as well. It is a business based in Kazakhstan, and the shares are listed in the US. It's called Kaspi. They operate the biggest fintech platform in Kazakhstan, so everything from banking to e-commerce, buying a car or a house, making payments, anything you can think of. Kaspi's platform is dominant in Kazakhstan. And then about a year ago, they bought majority control of a similar business in Turkey. That business just didn't have a bank. So then they then separately bought a bank in Turkey, and they're busy integrating those two businesses so they can also have a dominant platform in Turkey. The business that they bought in Turkey is called Hepsi Burada, and it was profitable, but they've announced now in their recent results yesterday, they are looking to manage Hepsi Burada to be just break even. So what that tells you is, in the short term, Kaspi's profits are going to be under pressure as they try to win market share in Turkey. But longer term, if they can do in Turkey what they did in Kazakhstan and be a dominant platform, I see a lot of upside for Kaspi. So we are backing their long-term strategy, even though it might mean short-term pain in terms of earnings. And that's why Kaspi is my stock pick tonight.
All right, let's leave it there. Thank you so much for your time and sharing your insights with us this evening. Thanks to my guests, Jean Pierre Verster from Protea Capital Management and Alex Duys from Umthombo Wealth. And that's all for Stock Watch today. Don't forget to tune in on Thursday, the 5th of March at 11 a.m. as we'll be bringing you the live presentation of First Rand's interim results. Up next, though, it's the close.